Assalamualaikum and a very good evening to Dr. Shahrin and fellow friends. We are from Group 2. We're going to present about the financial ratio analysis between Darby Plantations Berhad and Genting Plantations Berhad. So my group consists of myself, Aida, Fatimah, Johari, and Shaza. So I'd like briefly introduce about Darby Plantations, about the business operations, where it consists of upstream operation and downstream operations. It encompasses 241 estates and 70 palm oil mills located in Malaysia, Indonesia, Papua New Guinea, and Solomon Island, where fresh fruit bunch from estates are delivered to our mills, to their mills, to be processed into crude palm oil. So this is about the real estate and plantations. And they also have research and development capabilities, encompass all research area requirements across the value chain, committed in developing, applying, and transferring relevant knowledge, research findings, and technologies to improve the customized downstream products. Okay, so let's have a look about the downstream operations, where Darby Plantations renewable energy focus on value accretive activities, renewable energy sector, such as solar, biogas, and biomass projects aligned to the group's sustainability goal of lowering carbon emissions. So we also have the current downstream operations, such as where it's comprised the production of oil and fats, oleochemicals, biodiesel, other palm oil derivatives, as well as the sales and marketing of all of these products. About the Genting Plantations, it consists of 4 divisions, which are plantation, property, biotechnology, downstream manufacturing, and where the first one, the plantation of the all palm trees, and the fresh fruit bunch productions from have been processed, have been brought to the downstream manufacturing, to process into the palm oil and palm kernel, where the total land area of 443,446 hectares in 2020, and it's also within the largest area in Malaysia and Indonesia. And property division established its reputation as developer of quality residential and commercial properties aligned with house ownership campaign. And also Rumah Mampu Biaya Johor. They have a project called Genting Indahpura and also Genting Pura Cendana, and this also support the premium outlets like in Genting in Johor as opportunity for improvements. They are not relying only on the residential. This is to increase their revenue. Okay, biotechnology division, where they focus on the biodiesel plant, to focus on the cost-saving measures by expanding the usage of liquefied natural gas, they call it LNS, and they have successfully replaced diesel with LNS at Genting Musimas refinery, where Genting Plantations also has been granted Bioeconomy Transformation Program Trigger Project status by the government in 2015. Last one is the downstream manufacturing, where high-value chemicals with multiple end product applications, including lubricants, surfactants, and detergents have been produced, and also high-performance palm oil derivatives, such as using the green and efficient process at significantly lower production costs and capital investments as compared to the conventional petroleum-based process. So let us go to the liquidity ratio. This is to gauge a firm's capability to fulfill its short-term, which is less than 1 year obligations. And as you can see that we have calculated from the year 2018 to 2020. Current ratio. The purpose is to measure the company's current assets against its current liabilities, represents the company's health and liquidity. For Darby Berhad, 1.56 suggests in 2018, suggests that the efficient management of working capital, they had better ability to pay off their liabilities in 2018, and also with their current assets. Which is cash and equivalent and account receivable and also inventories. So in 2019 and 2020, 1.04 will be too tight to sustain their financial health. And Genting, Plantation, Berhad, 3.33 considered high in 2020, where a ratio over 3 indicate the company is not using its current asset efficiently or not managing its working capital properly, thus affecting the financial well-being. It's declined to 2.74 in 2019 and further declined to 2.42 in 2018. Means Genting Plantation not efficiently utilize its current asset or its short-term financing facilities. Okay, let's have a look for the quick ratio, where it calculates the company's ability to pay off current liabilities with quick turnaround assets, which a quick ratio should be greater than 1. For CW Berhad in 2018, a higher quick ratio indicates firm could pay off its current liabilities 0.76 times over using its most liquidated assets without selling their inventory. But 0.6 times is less than 1, so it indicates Sime Darby not enough liquid assets to cover its short-term financial obligations. The quick ratio 0.69 in 2019 and 2020 reflects that current asset of Sime Darby heavily depend on inventories because quick ratio is conventional compared to current ratio because they exclude quick ratio excludes the inventories. Okay, Genting, Plantation, Berhad, the ratio is 3.11 times in 2020 and considered remarkably high as compared to 2.46 times in 2019 and 2.08 times in 2018. And industry average is only 1.12. So quick ratio that is too high also means that some of your money is not being put to working capital appropriately, so which indicates inefficiency. In this case, investment is recommended or highly recommended. Thank you.
Hi, my name is Muhammad Johari, and I will present and highlight on leverage and profitability ratio. Leverage ratio are used to measure company true value of asset, equity, capital, and asset to equity with comparison with the overall debt value. When the company shareholder own the majority asset, the company is said to be less leveraged because it doesn't maximize the utilization of its resources. Nevertheless, it is also depending in the industry to determine their liabilities for profit maximization. So for Sime Darby Plantation, DA have maintained for 3 years from 2018 to 2020, average at 44% liabilities compared with their asset of 56%. The debt improvement in 2020, DE showing decline by 2% from 2018 to 2019 and continues decline to 6% from 2019 to 2020. This shows the company ability to improve their debt using shareholder equity. AE shows decrease, showing they have shifted a proportion of their financing from debt to investor equity. In view of Genting Plantation, DA have maintained for 3 years from 2018 to 2020, average at 30% liabilities compared with their asset of 67%. DE show decline by 40% from 2018 to 2019 and continue increase only 0.01% from 2019 to 2020. This show the company ability to improve their debt using shareholder equity. DC trending decreased from 2018 from worth 0.05% and maintained the same from 2019 to 2020, showing the efficiency in allocation of the capital in each of the business. AE show decreased significantly from 2018 to 2019 with 14.88% decrease. This increased by 0.01%, showing they have shifted a proportion of their financing from debt into investor equity. So for cross-sectional analysis, we can say that for both company in 2020 are reported downward trend in leverage ratio. The company still reported the highest value for the year 2020. Okay, so moving to profitability ratio. Profitability ratio measure a company profit from its operation on how efficient a company in making profit using their asset. It is measuring the return on investment in equity for the value for shareholder. Comparing with the 3 years, in 2020, the profit margin ratio considered high in 2019 for Sime Darby Plantation. The increase is due to the high net income by diversify the business model and improvement in capital management. In 2019, profit margin declined mainly due to the improvement, due to exit in JV with oleochemical and biomass business and sell the group operation in Liberia. And also because of the pandemic, COVID-19 impacted the lower crude palm oil, CPO, and palm kernel price and lower fresh fruit branches production lah. So for ROA in 2020, Sime Darby Plantation generate increased income with 4.2%, showing they well in asset management. ROE is measuring the company ability to make profit from its shareholder investment. In 2020, showed efficient growth due to the new business model implemented, and comparing in 2019, turned into negative digit due to the inefficient growth, and also lower in 2018 due to the changes of financial reporting and world issue on oil palm. For Genting Plantation, show a good profit margin from 2018 to 2020. Decline in 2019 is reported due to the dry weather condition and reduce in harvesting due to replanting. ROA also maintained at a greater position, which from 2018 to 20 an increase in 2020. The increase in 2020 is due to the expanded the processing capacity to continue growing harvest in Kalimantan Barat, Indonesia. ROE show the incremental positive growth in investment of shareholder in 2020, which indicates increase and slightly lower in 2019. And maintain increase in 2018. The growth also contribute by the company quickly lifted operation during the MCO and COVID-19 pandemic. So, this actually comparing for both company, SD and Genting, actually both need to improvise their operational efficiency to grow profit maximization of shareholder. In general, investor will look into the company growth before they gain confidence to invest in the company. So a company who have a greater profitability ratio will become more attractive to the investor. As an essential sector, this industry need to quickly lifted for sustainability. So we can see in 2020, in terms of profit margin, Genting show the greater comparing with SD Plantation. However, for ROE and ROE is still dominant by SD Plantation, and they are still dominant in the industry. And the trend also is in green and growth. So that, thank you so much.
Continue with activity ratios. An activity ratio is a type of financial metric that indicates how efficiently a company is leveraging the assets on its balance sheet to generate revenue and cash, commonly referred to as efficiency costs. Activity ratios help analysts gauge how a company handles inventory management, which is key to its operational fluidity and overall fiscal health. Activity ratios measure the efficiency of a business in using and managing its resources to generate maximum possible revenue. The different types of activity ratios show the business ability to convert different accounts within the balance sheets, such as capital and assets inflow, cash or sale. These ratios are also known as asset management ratios or performance efficiency ratios. The account receivable turnover ratio, also known as debt ratio, is an activity ratio that measures the efficiency with which the business is utilizing its assets. It measures how many times a business can turn its account receivable into cash. It is calculated by dividing the net credit sales during a specific period by the average cost. The average account receivable is calculated by adding the value accounts receivable at the beginning of the desired period to the value at the end, and then dividing by 2. For activity ratios, we have four types of activity ratio, which is accounts receivable turnover, which is net credit sales divided by average accounts receivable. And then we have working capital ratio, which is net sales divided by working capital. And then we have asset turnover ratio, which is sales divided by average total assets. And then we have ROE, return on equity, which is profit margin, times asset turnover, times financial leverage. And we also have fixed asset turnover ratio, which is net sales divided by fixed assets minus accumulated depreciation. And also have inventory turnover ratio, which is cost of goods sold divided by average inventory, and days payable outstanding, which is account payable divided by cost of sales divided by number of days. So as we can see here, the calculation for activity ratio, we can see that Sime Darby Plantation said on its third quarter, net profit from continuing operation more than tripled to 635 million from 190 million over the year. But also the result of performance of Genting Plantation Berhad with economic, here we can see economic variable and risk. Therefore, if the companies want to increase the profitability and survive the global market, they have to manage the risk effectively. As you can see here, for the Sime Darby, said on its third quarter, net profit from continuing operation more than tripled. Okay, its operation contended with a COVID-19 pandemic driven labor shortage in Malaysian upstream oil palm operation. A bit about market ratio. We'll write up about the market ratio, which is means current market price, we will divide by the performance, earning per share. Market value ratios are used to evaluate the current share price of a publicly held company stock. These ratios are employed by current and potential investors to determine whether a company's shares are overpriced or underpriced. Dividend yield is calculated as the total dividend paid per year, divided by the market share price of the stock. Is the return on investment to investors if they were to buy the share at current price. So as we can see here for the calculation, we calculate three performance here for both Genting and Sime Darby. So Sime Darby Plantation Berhad corporate credit rating at AAA with a stable outlook. Okay, and strong cash flow and improvement in its financial and high crude palm oil price. On the other hand, Genting Plantation Berhad's net profit the second quarter ended 2021 surged more than fourfold to 104 million. Coupled with higher sales from its property segments, which exclude the impact of lower sales volume from downstream manufacturing segment.
So I will continue with the DuPont analysis. The DuPont analysis is used by investors as well as the company itself to study the firm's financial statements and assess its financial state. So this analysis is used to evaluate which components in the firm that will be able to determine what contributes the most to the return on equity or ROE. Why is it useful? Because it gives investors the tool to be able to compare the operational efficiency of the firm with another similar company, whereby investors will be able to benchmark, or even in the company itself will be able to benchmark the company's performance with another company, similar company. So it also allows managers to identify the strengths and weaknesses of the company's financial activities. So the DuPont formula is basically comprises of three components, which is how you get to the ROE is by net profit margin, total asset turnover, and financial leverage multiplier. So we'll start with Sime Darby's Sime Plantation Berhad's ROE first, whereby we can see that in 2018 the ROE is 2.3%, and in 2019 it decreases to 2.04%, but in 2020 it increases multifold into 11.31%. So the profit margin decreased in 2019 by 2.5%, but they had an increase in asset turnover. So it could be due to lower profits due to low crude oil prices and also lower proceeds from the disposal. So the ROE in 2019 is lowest compared to 2018 and 2020 because of the group's inability to fully monetize its planned divestments and land in Malaysia. So 2020 sees an increase, as I mentioned before, by 9.37% at the net profit margin and an increase in the ROE itself. So you could see that the ROE increases because there was an increase in the net profit margin. So the DuPont analysis made sure that you will be able to determine what constitutes the increment in the ROE, whereby is it the net profit margin or the asset turnover, or it could be because of the financial leverage multiplier. So when it comes to Genting Plantations Berhad, it also shares almost similar performances as Sime Plantation Berhad, where the asset turnover is stable throughout the 3 years, 2018 throughout 2020, and they also see a decrease in net profit in 2019 due to similar reason, which is lower crude price oil prices and also lower contributions from the plantations and palm products. And ROE increases sharply in 2020 despite COVID-19 market price volatility, whereby you have shortage in workers and you also have problems in terms of plantation production, because they played around with the price volatility during the COVID-19 pandemic, where there was a time of increment in crude price oil. So using the cross analysis between Sime Plantations and Genting Plantations, we could see that although the company shares similar performances throughout the years, we could see that Sime Plantations have higher net profit, Genting Plantations having higher net profit margin as compared to Sime Plantations. And also Genting Plantations have a lower financial leverage multiplier as compared to Sime Plantations. So this could mean that Sime Plantations have a higher debt to finance their assets as compared to Genting Plantations. So from the cross-market analysis, we could provide benchmarking between two companies on these three components: the profit on sales, efficiency of asset use, and use of financial leverage. Thank you very much.